Get these two gentlemen to come on up on stage, and we're going to get things rocking and rolling. Thank you very much.
That's yeah, the camera adds 10 pounds, right? Is that what? All good. Thank you. So again, my name is Pascal Saint-Jean. I'm the president of 3IQ. For those of you who may not know who we are, our founder, Fred Pai, took on the good fight with the regulators to bring the first fully regulated spot Bitcoin and Ethereum products globally on an exchange. And today, we're one of the largest digital asset managers globally, and trying to bring more innovations to the market. And I'll share a little bit about my entry into crypto. We all have a crypto story, and it relates to what we're going to talk about today and what we're trying to do as an organization. So for me, my background's in engineering, particularly in distributed systems, and I used to have an open source company years ago, and I hung out a lot in Seattle and Portland, where it was really an open source hotspot. And again, open source as a coding business model was very disruptive back in that time. I got exposed to Bitcoin from the technology side, not actually from the investment side, and it was very fascinating to me because it made a lot of sense based on my background. And fast forward about 5 years after that, I sold my business, trying to look at the macro lens, the investment lens, looking at where I was going to deploy my capital, and all roads always led back to Bitcoin. So I became an investor very early on in 2015, although that's not super early compared to some people in the room. And since then, really been involved in the space, trying to help companies scale. And as I was mentioning yesterday, our philosophy at 3IQ is really not about marketing, but about education and research. And we're really proud to have brought in Mark Connors, ex-head of research from Credit Suisse, to our organization, who's really helped build our whole research and education department over the past several months. And I'll turn over to him to do a quick intro. But our goal today is really about combining the concepts of macro, what's happened in history, what's happening today, and how it intersects with Bitcoin and crypto in the future for our economy and our society. So with that, I'll pass over to Mark for a quick intro, and we'll get this going.
Thanks, Pascal. First of all, thanks everyone for your attention and for all those who've spent time telling me about your expertise, how you got involved, and in particular, what your opinions are about what's going forward. That is part of my process, but I'd like to tell you a bit about myself first. Personally, I'm a father of 4, married 30 years, and you learn more from your kids and your family than you do from any textbook, and not all of it is good. You learn about yourself through your kids. And the reason I mention that is because then professionally, that leads into, you also learn from your mistakes. Not that my kids are mistakes, but you learn from their mistakes. And for me, professionally, I think the juncture point where I pivoted my career from sales and trading into strategy analysis was in 2002. I started a hedge fund. We were successful in the bear markets of 2000 on a prop desk. My partner and I left, started a hedge fund, put our first trade on October of 2002. I think it was the 16th. It was the bottom in the market, the height in credit spreads, but we still had a very bearish outlook. We didn't hear the bell go off when HSBC bought household finance. We didn't see the change in the Fed policy. We just didn't see it. It wasn't in my sample. And we pushed the market, eventually closed the fund for underperformance. So since that point, I've tried to expand my sample. I've tried to understand what the market does. And that's what hopefully you're going to see today, is taking in data from economics, which is a study of behavior, essentially, how it relates into markets, how that economic capture, store, and transfer of wealth goes into markets, and the players. Obviously, with the resignation of Liz Truss today, players are important, and we're seeing, you can get a lot of feedback, again, among those 3 silos. That's our process, and so let's go and see how it rolls.
Let's go to the next slide. And okay, next slide again. Everyone knows who we are. Of course, we have to say this is not financial advice. Basically, what we're doing is our opinion, our research, and really the end decision is up to you, but we're trying to educate as much as we can. Next slide, please. So before I turn it to Mark, the 3 takeaways I really want you to think about as we go through the journey together over the past hour, over the next hour, is really looking at the problem. We want to talk about the remedy, and we want to talk about the urgency and the opportunity. So that's going to be the flow of our agenda, and Mark's going to lead us through that. So Mark, lead the way here with the timeline.
Great, thanks. So Bitcoin is just part of the ecosystem. It's not about Bitcoin. Bitcoin is the window that's opening when the door closes, as it has in every monetary regime. So in World War II, while the war is raging on and unresolved, you had 44 countries go to New Hampshire. We all know the story of it. But what I think we don't know is that that was the first massive change in technology. You had countries agree in a coordinated effort, think of coordination versus what's going on today, put the money 22 floors below the Federal Reserve in New York via ships during a war, and trusted that that currency would help repair the world, and fingers crossed an Allied win. Well, they won. The Marshall Plan and other plans went through and rebuilt Germany, Asia, and the rest of the world. It worked. The velocity of money, because this new technology and the trust, was something that's not really discussed a lot, but it produced economic growth that we have not seen since. But that stopped in '71, another war, Vietnam. Deficit spending drove the US into 3 straight years of deficits they haven't seen prior to World War II. Nixon then, on that famous August 15 night, Sunday night massacre, says, we are temporarily suspending the exchange of gold for dollars. Well, just like World War II, inflation sets in, and then it ushered in the petrodollar, a way to keep the dollar relevant and tied and get that exorbitant privilege going. Again, when there's war, there's excessive spending, and there's a remedy with monetary technology. And that brings us to today. And I stole this from a guy named Zoltan Pozsar, who's probably the #1 Fed watcher I used to work with. And we had a few joint conferences, and then he wrote this in like what they call in a newspaper in the old days, below the fold. It wasn't a primary topic, but he said wartime finance, and I'm like, yeah, it's a global response with a debt funding that we have not seen since World War II. And that has reverberations. So I'm trying to show that this is an epic. Whatever happened in the last 5 or 10 years, '08, it's a bump. This is a very different period we're in, and we're going to go through and show you a couple of slides to give it more perspective.
So next slide, please.
So for almost 40 years, the money supply and the growth, the darker blue, in market cap, I'm using Wilshire 5000, which is like the S&P times 1.3. They grew about the same, 7-8%. And GDP, with variability, clipped at 3. So that works. You have financial growth because of leverage, et cetera. That's in excess of the economy. It's a comfortable ratio. If you're an asset owner, you're not being killed. If you're a wage earner and you only have GDP to survive, you probably want to buy equities. They're growing faster. So we kind of know that. You want to be an asset owner, not just rely. You want to own, not rent. And that existed 35, 40 years ago. But it changed drastically in '08 when the central banks issued debt, bought bonds, and drove interest rates lower. So the increase in money supply then grew to a level not contemplated. Again, I talk about sample. It was not in anyone's sample to consider that we would ever, within a 20-year period, have this much monetary growth. We did, and it favored asset owners, people in the equity market, people who own homes. So the graph we don't have up here, but we shared with a few folks at our booth, was looking at wage earners, wage growth over time versus housing growth. So we don't need that slide because I think a lot of us know what that looks like. Houses used to be 4 times the wage growth. They're now 8 to 10 times. That's a tough gap to fill. So any questions, Pascal?
I was going to say, the key takeaway here as we talk about sometimes these different terms is when you're saying nominal GDP is not growing with the amount of effort that's being done by the government is, I love when you talk about it's really wage earners, right? So GDP is our collective productivity as a society versus asset owners is basically a money investment. So what we're saying here is those who are not owning assets and those who are working for a living are seeing assets getting further and further and further away from them, whether it's stocks, whether it's real estate or businesses or anything like that.
Yep. Every asset turns to a liability over time. I don't know many that don't. Bretton Woods was an asset. It really served a purpose. It's being abused and debased, and it's resulting, and it's impacting the wage earners. So that's the main purpose here. Next slide.
Next slide, please.
So that data we looked at was Q1 of 2022. This is Q2 of 22. So nothing really changed. Hopefully our data works because we locked in 07, we locked in 22. So that should change a little bit because we roll in 22, Q2. GDP is lower again, but so are equities, because the best buyer in the world, the Fed, is now saying, I'm a seller of bonds. I'm going to be hiking rates. I'm going to be hiking mortgage rates, and risk appetite goes down. Stocks go down because of discounted cash flows and the way that equities are valued, especially tech stocks. That's going to continue. That 11.2 is going to come down. That 1.4 is going to go negative. Potentially, we can't make predictions, but at this rate, to go to 5%, which is what's targeted, that's going to continue to happen.
So can I ask a question around like the K-shaped recovery that we heard during COVID, asset owners versus basically wage earners? What we're saying here is, with raises in interest rates and potentially quantitative tightening, we'll talk about if that's actually happening or not. We're seeing asset, basically being repriced, but there's also an impact on wage earners.
And there's also an impact on wage earners that is rolling through, and we know unemployment didn't even kick in. So let's stick on that. I don't know when we bring it up, but that K recovery, which we know asset owners did okay and wage earners didn't. There's a theme on inflation that we call K-flation that we want to bring up as well at appropriate time.
Next slide.
Okay, so money supply came in, and it's like gasoline. When you pump your gas in your lawnmower, and you're like, let's go, and you push it too much, and it floods the engine. That's what the Fed did. The money came in, and it went right to assets. The real economy then just stalled. That's the velocity of money. It's basically saying, how efficient is this technology of money? And it wasn't very efficient. It immediately got sucked away and burned up in assets. It did not ignite the real economy. And if they keep using that tool, which they will, more of the same will happen. Now, we get to the remedy and the fun part in a second. But this is a scorecard of the Fed right now. It's not very good. The blue line is money supply in dollars. That's 25 trillion. And that is the cycle rate of that dollar in the economy as measured by GDP.
I think it's a really important slide because, fundamentally, what the thesis of what you're trying to do is the more money they print ideally goes into the economy, and it's like an engine that people will start spending and using it more. What we're seeing with velocity is that the dollars are not turning around at that pace. So people are just putting it away into hard assets, which is inflating everything around us.
Yep.
Yeah.
Next slide, please. So people say Volcker, that, let's be like Volcker, let's raise rates. Volcker could do it because there was no debt to GDP. Volcker could do it because you had a different demographic in the workplace. We cannot do it because we are more like World War II, except that we don't have the demographic tailwind. We don't have the globalized, coordinated growth that helped propel industry. We have none of that. We have debt. We have an aging demographic. Very different. So that's why we think we're going to get to that window opening, because we're talking about doors closing only now. We think that there will be a break like we're seeing in the Bank of England, which had to borrow money from the Treasury to satisfy a loss of $10 billion. I believe it's the first time in its 350-year history. So stuff is cracking at large institutions at a foundational level where there's no bailout.
And literally happening during this conference.
Yeah.
This is not months ago. It's happening today. We're
We're
waking up to this news.
We didn't know that. We just got lucky. So that's the thing. You can negotiate a lot in life. You can't negotiate debt away.
Anyway, and I wanted to ask a question around this because a lot of people will debate saying, well, they raised rates back in the day and everyone's saying, let's just go back to that 10, 12% like they did in the 80s and fix the problem. But again, going back to demographics, how much debt's in the system, those tools of, World War II, grow your way out of it by population growth and productivity growth, in the 70s, grow your way by just being aggressive on the interest rates. Right now, like you're saying, just to repeat those takeaways, demographics aren't supporting the narrative and interest rates, there's too much debt in the system to keep going.
Who's under 30 in the crowd here? Okay. I'm maybe giving myself away. So your credit card, I know when I was 30, I lived on the thing. So your credit card, imagine that you had a 6% rate and you were maxed. And they said, actually, I'm going to triple that. So now you're paying 18%. Your ability to manage that might be a little difficult. Let me then add, we're actually going to take your credit away. The Fed has only hiked rates now. They haven't taken it out of the system. They've only taken 1% of reduction. In 2018, they took 3% away, and it cracked the system on a lower debt profile. The overnight fund rate went to 10%. So they are the last buyer of resort. So think of that. Rates are higher. You might be able to absorb that higher rate, that triple rate for a couple of weeks. Maybe, you kind of go back to the basement, home, whatever. Like, maybe, I'm not saying I did. But, maybe you manage it. But if they pull the liquidity, you have to pay it. That's when you default. That's not going to happen. That's why we're going to pivot by Q1.
And we'll move. I think we're moving now to the remedy and opportunity. But I think what we're trying to do here is give real life examples of history and data, but to relate to day-to-day life. I think I have a lot of family members, and people in my circle are saying, we're working hard, we're earning a decent wage, we're together, we're staying together, trying to save up for a house or save up to buy a business or to do something. And it feels like the harder we work, the more we save, the further away our future seems to be. And that's just the reality of what's happening. And these are all related back to policies that government's doing.
Yes. So think yourself you're in 1980, and we're here and we're saying we've had inflation, but you know what? I think you should buy a house. And they're like, why would I want to buy a house with 10% rates? That's where you are now. We're all in that. We're in a pivotal period, and you have an opportunity, and we're going to go into that more. But that's where you are. We're not behind the 8 ball. We actually have something that we're just starting to understand.
Next slide, please.
All right. So then the last crank here, we call it the monetary ratchet. And again, in a panel we had earlier today on trust, I believe, or no, it was on the crypto. They were navigating about anonymity, pseudonym. Can someone help me? Pseudonymity?
Yes, that's right. That's right. No, you had it.
All right. And privacy. And then they said, okay, how's it work? When people say, anonymous, they really mean privacy. Language is important. And as a group in the Canadian blockchain, getting language together and defining terms should be the first thing we do. That's how democracies start. You define the terms. This is a monetary ratchet. It goes one way. They're never going to pivot. They've never pivoted. They've never reduced money supply, ever, even when they could, when it was easier. There's never been a 1-year rolling negative decline in the US money supply. We only have data since 1960. Never. And it's going to be harder to roll it back now. So if they say we're going to do this and that, ain't going to happen. It would destroy, crush the financial system. And the Fed has a third hidden mandate, and that's financial stability. And that would absolutely destabilize the market. So just trying to set the stage here.
Next slide.
The good news. Okay. So in 1971, when Nixon let go on that Sunday night and inflation ensued, it just like this, dollar strength, EM was being washed over, defaults all over the place. Chase Bank, which is part of JP Morgan now, hat in hand went to DC for help, all bailouts. But the window opened for them in 71. And that window was the FX market. If you broke the dollar peg, everyone's floating now. How do you get goods to exchange? Banks entered a new market that didn't exist. And it became their #1 market. It's the only reason Citibank exists is for their FX market globally. It has been. It's declining now because margins are down, so they're looking for something else, Maybe it's digital assets. That's the window. It's not new. It's happened in every epic change. So what you look at here is what monetary policy does when you have a ratchet. Eventually it leaks in and it separates, it diminishes the value of the technology. It puts asset prices at a higher rate. Wage earners who aren't on that boat yet are left behind. So that's what you're looking at in US and Canada inflation rates, which are woefully understated because we all know that healthcare, colleges, and housing blew well ahead of 2021, 2022. But Bitcoin's inflation rate, we're talking about Bitcoin for now, but we talk about digital assets broadly. Bitcoin has integrity. And I love this definition. Integrity is the ability to perform regardless of circumstance and time. And that's what you want in money. And that's what Bitcoin, we believe, and has done and will continue to do. And that's why it has a codified inflation rate. So,
and then it comes back to a bit what we were talking about, the panel I was on yesterday, in terms of like, we're really in a short time span here. This is a long-term historical look, right? And basically, we're talking about I was talking about the resiliency of the technology, the hash rate attack, the interest rate attack, everything Bitcoin still moves forward. And as a monetary policy, it's baked into the code, right? So we know where the governments are going. We know where Bitcoin is going. We just have to expand our horizon in terms of timeline.
Right. And I felt this, but being data dependent, I wanted to increase my sample. And that's what we're trying to do here. Some people, I forgot who said, there are no new ideas, just a non-normally distribution of ideas. So these ideas are here, they've happened, and we're trying to bring them towards the middle of the distribution so people understand it and can adopt to help narrow that gap between wage and assets.
Next slide, please.
Thanks. So we talked about what happened in 2018 with the repo market cracking when JP Morgan said, I don't like the regulation, I'm walking away. The Fed used to have 44 primary dealers, I think maybe 45. They were mostly US. I think they're all US. That diminished to 21, and only a third are US. They need fewer people and globally. There's only one planet, last time I checked. They can't go any more geography. People in the US are running out of it. So their market, the repo market, the financing market on a growing pile of debt is getting smaller and more fragile. Bitcoin, digital assets, very different story. Exponential grower, it's going up and to the right. And this is wallets, which is a proxy, because we know that large exchanges have had a lot of growth. They only have 4 or 5 wallets. So as far as units versus volume, we know this underrepresents what's going on, but it's the best proxy we have. Maybe I'll talk to folks to get better proxies. Please email me.
And we talk a little bit more about we hear a lot about repo markets, and it's very complex for those who don't fully understand, but really it's the overnight global lending ecosystem. And when that halts, liquidity dries instantly globally.
The entire financial system stops overnight if the repo market breaks. The Fed will continue to be a lender of last resort, but that will also cause issues because maybe not everyone has access. So again, when you limit liquidity, we know good things don't happen.
And so I think at the conclusion here, what you're trying to say is that there's less players on the repo side, which is increasing risk, and more adoption of digital assets, more wallets, more people holding, more people hodling.
Resiliency, integrity from breadth, and that's what's happening.
Next slide, please.
That's why Pascal's here. I have ideas, but they don't always come out. So thank you, Pascal. So this is what our analyst, Connor Lowen, did. I asked for other ideas of institutional adoption, and so he's good at expanding his sample. He went into 10 Qs and 10 Ks in the US over time, searched by those keywords, and he got over time how many companies have used these words in their documents. The reason we do that is because companies do not put anything on paper unless they have to. If they're going to expand into a market, they have to broadcast it. That's what their lawyers are telling them. They're not doing this because they thought it'd be a good thing to do. They did it because it's on the docket. It's, I believe, happening at a rate that's increasing by mentions. And 2022 was done through May month end. Its annualized rate, even with the winter, is higher than 2021. So the rate is only increasing on institutions. It's the great migration. They see the window. They sure as hell know the door is closing on margins and opportunity in their traditional businesses, and they're coming.
So one key thing, we had done this slide a while back, so the data had to be updated. But to Mark's point, that last peg may seem to be down, but by the end of December, if you revise that, the trend is higher than 2021 in the middle of crypto winter. So more companies publicly traded are talking about it on their 10K reports, which is a huge deal. Next slide, please.
Okay.
I love this slide, by the way.
Yeah. So we know exponential growth, and the one that we don't show is if we had gold or equity prices over the same time period, it would look like parallel to the axis. Obviously, not an exponential grower. So that's a thought. The fact that we're even using a logarithmic graph to represent is a big deal. And if anyone's in the investment field, please ping us, because we show the distribution of Bitcoin over any 1 year period, 1, 3, 5 year, 10 year. It's all positively skewed. There's no asset, no stock that has a 10-year history that's positively skewed beyond like 0.5. It means that there's averages, and then it punches way right and makes much more. Average, punches way right. Other assets are normally distributed. The reason is adoption. So exponential growth, Currently, or over this history, Bitcoin, as we know, has only been below that line, that 200-week moving average, 2.5% of the time. Right now is one of those times. So this graph we like because people, it's whatever you like is fine, but when people say, hey, what about that? I listen. People asked about this red light, green light, 1, 2, 3 graph. Now, Pascal, I don't know if you want to go, talk about it or what your take is, because you've talked to some investors about how it correlates to the cycle.
Yeah, well, basically we were talking about yesterday, and oftentimes in some one-on-ones, like, yes, people are saying, well, it's correlated to technology stocks. It's Bitcoin never been exposed to interest rate hikes. The reality is, if we look in the past, there have been cycles, there have been boom and bust cycles, and every time the bust cycle goes a little higher than the previous boom cycle. So yes, people, it's easy to point to short-term thinking that, oh, look at this, it's not going to survive the interest rates, it's getting hit a lot harder. What I see is resiliency in the technology, and one of the hardest times it's been tested in its history. What I'm seeing is lower volatility on the downside, considering how much volatility has existed even just in the crypto market with a lot of the liquidity crisis we saw with 3 Hours Capital and Celsius and others. The system just readjusted and works. And that's what's beautiful about this. And I think what we're trying to show here, without giving financial advice, is that there are opportunities, right? It's basically be greedy when others are fearful, and fearful when others are greedy. Well, right now a lot of people are fearful, so we have to be contrarian.
Yeah, and just show the facts and then do the work. So basically, we have down years, kind of, if the halvening are 2 trees, and the hammock is the price path of Bitcoin. I think it was in September or so. That was the low point, right between the halvening, and that happens to be the period when you have annual losses. That's just in the past. Will the halvening happen? Will the past behavior occur? That's what we're talking about, which is the remedy and a bit of the urgency also in our message.
Next slide, please.
Again, FUD. Who were we talking about just coming up here? A couple facts. Ethereum. Let's give some love right out to the newly merged Ethereum. 11 trillion in transactions last year versus 10 trillion for Visa. I mean, I think very few people know that stat. The transactions are different, but it's a trajectory. It's meaningful. Other facts that people don't really appreciate is that Ethereum and Bitcoin have performed better, even in a crypto winter, relative to their own history, because of adoption, because of hodlers, for a number of reasons, including the problem in TradFi. It's stabilizing relative to itself, its own history. It's not going to be lower volatility than the US 10-year. It can't be, but it can be improving itself, and it has been, versus just the storm of volatility that we say, ask me anything, I'm certain about what's going on, and I'll say that word. There is a problem in TradFi, and I don't yell often. I am yelling right now. It's cracking. It's a problem, and it shows up in data. So this makes all the sense in the world about the problem and the remedy. It's bearing out in the asset prices and their behavior.
And talking about the remedy, like you were saying, it's lowering volatility against itself, right? So again, we can expect a high vol asset to go to zero vol instantly, but it is getting better over time, which still means there's opportunity. Volatility is opportunity, and we would look at general right now in the economy, whether it's real estate, business valuations. I have friends who raised at 33 times sales this year are barely lucky to get maybe a 12x on revenue and valuations on private companies. That's happening everywhere. So it's happening, certainly it's happening in digital assets as well. But when we look at assets compared to themselves, we're seeing price performance outperforming everything else in digital assets right now.
Yep. And just to go back to what happened, even though Q2 was a disaster for prices behavior, it was the plumbing, not the protocol. So crypto went through their September 2019, not 18, I said earlier, September 2019 repo failure. They went through it, washed out all the bad players, hopefully the majority of them, but the protocol performed. And so that distinction is lost on many people. Back to language matters. Centralized, unregulated entities, not DeFi and not regulated entities. Next slide, please. So it's like, yeah, but Bitcoin's down 58% this year. It is. But when growth concerns happen, maybe it reasserts itself. This is not the first time it's happened in this 12-month period. It outperformed in Q3. It went through its own storm. It endured it. Not going to say that we're not going to have another down period, another down leg. I don't think it'll be persistent, in my opinion, given past behavior and current adoption rates. So here's the data. It's Q3. And I don't know, you can go next slide, please. I don't think we have it, but I'll speak to it. Last week, Bitcoin also outperformed on a down tape. So it's not new. It's happening. I'm not going to say it's going to pop higher, but the behavior, the integrity is bearing through. So the question is, what is Bitcoin as a proxy for digital assets? Remember, Bitcoin, Ethereum, and stable coins are 75% of all digital assets. So it's using Bitcoin as a proxy. Which one is going to show up? The one that's down, 68% on a rolling 1-year basis, or up 141, which Ethereum is showing up. We think the integrity of the protocols and the adoption and the remedy that institutions are going to make the 3-year the one that's going to bear out over time. As that red light, green light, 1, 2, 3 graph also showed, we're in a cycle. We've gotten more mature, we have more adoption, and we have integrity that is lacking at the monetary policy level in TradFi.
And I think it comes back to you when you're talking about the opportunity and the remedy. We know that history will continue. In other words, asset owners will benefit, wage earners will suffer. So how do we gain access to assets? What are types of assets out there? We know real estate, really hard for a lot of young individuals to get into the market. Buying a business or starting a business, high risk, high reward, but very difficult. But to buy one also like extremely difficult. So digital assets, fractional ownership, easy access. Again, that's what we were talking about yesterday as well. And the banking ecosystem, the lending ecosystem against a hard asset like Bitcoin will enable individuals to benefit from that asset. So we need to find a way to get into asset ownership, even if we can't buy a $2 million home. So, that's what we're trying to say here is that opportunity of you need to jump on the asset ownership bandwagon. Is that fair?
Yep. And yeah, so that is, when we look at that sort of sinking ship in TradFi, stepping off onto the platform of digital assets as an owner of a digital asset, Ethereum and Bitcoin are ones that we've done work on in particular. The majority of our work, and there are others as well. But I also think that it's not as much of a leap. When you look at GDP that we mentioned, shocker, maybe that isn't getting the whole economy, that $100 trillion GDP number globally. The IMF thinks that there's about 16% not captured in something they call GDPB. So I think it's actually running. Certain institutions and people see it, back to the point about no new ideas, just an unequal distribution of existing ideas. It's there. And digital assets are positioned to capture it, whether it be in the, who's the KPGM, who's talking about?
The metaverse and the digital assets and ownerships and
20 billion of economy trapped in, Fortnite. My kid, I don't know how much money he spent on it, but God, now I know, I'm going to find out. But so it's happening already. So it's not that much of a leap. And we're trying to give data to get engagement and get feedback. Because we don't know everything. I've told you what I've missed. There are other trades I've missed. This one, I'm getting up the curve on. Hopefully with you, and positioned to be there when it continues to rise.
So I guess what we're saying is GDP is not capturing actual opportunities to earn income in the digital economy that is growing in the billions each year, and that asset ownership will be critical to make sure we keep up with the policies that are happening in the system.
Yeah, I do think the U.S. gets it, whether it's Silicon Valley chirping in Biden's ear, because I've never seen a more uniform. If anyone hasn't seen Janet Yellen speak in April at the American University, it was like something out of Manchurian Candidate. She was just like, Satoshi Nakamoto, his white paper was the best, and it was wild. She read off a teleprompter, and it was the most shocking thing I've seen in politics. And there's been a lot going on. Everyone has been given marching orders. President's Working Group on up to CFTC. SEC is the only one fighting right now because they don't want to lose this, but they're going to try to get their turf along the way. It's happening. They know they need the money. They see the 16% not captured. I guarantee you that they found it out. Like, we got to get there. So they're going to do it, which is why Canada, U.S. is coming here. Fidelity's already here. So on regulators, watch that game because it's happening.
That's I think the alarm bell I've been trying to ring as much as possible when I do a lot of events here, is saying Canada had a leap forward. I think we still have an opportunity, and we have to continue to come together to seize that opportunity that we were seeing that we created here in Canada. We could continue to do. If not, we're gonna sell like most businesses to the U.S. and let them capture all the value. And I'm sorry for my American colleague here, but I really am patriotic about this because we do have a huge opportunity, and I think it's worth for us to continue doing the work we're doing together to grow the space. Next slide, please.
And this is just talking about the march of adoption, and as many have said, we have a lot of regulation. 2014 was pivotal to have the tax treatment, allowed people to play in games. So the pace of adoption since that March presidential executive order has followed in the same language: responsible innovation. Protect the consumer, but invest in technology. They know the SWIFT system is terrible. They know there are problems. They know bankers are looking away. They know there's disintermediation. So they're gonna walk not in a straight line to try to capture that and to make sure that other countries don't capture it ahead of them.
So if we summarize, the journey we described over the past little bit, really, we talked about history repeating itself. There's a new war that was tackled, that where massive amounts of money was spent. The reality is the solutions from the past. So growing, demographics doesn't exist. Raising interest rates to a point where you could readjust is going to be very difficult. We've never seen in history a contraction of money supply. It's only going to keep growing, and it has to grow it exponentially to get the same amount of kickback in the GDP growth. What we're seeing is a digital economy growing where wage earners and people can have an opportunity to earn more money and then participate in the digital economy, because we know that assets are where it's going to be at as things continue. We have to find ways to earn more in the digital economy and find ways to invest more in digital assets to give you that opportunity to withstand what's coming next.
That's it.
Questions? We're done. So question, yes. There should be a big finale slide, but that's, yeah.
We got one question from someone says, is that I love New York? Is that?
I love tech.
I love tech. First question is, I showed the best foot forward for global finance. The slide we have about those three periods of 71 to 2008 versus since 08, and then the last 2 years about every G10 country, save for Japan, has done that, because Japan just pegs their to zero. They didn't do that. And they're internal savers, so they didn't have to do that. But every country is in the same situation, varying degrees of deficits. Europe is its own animal. A lot of problems over there because of that monetary fiscal disunion and rumblings about how to deal with it. So I don't know if I answered your question, but on the monetary policy, GDP, money, and equities, very analogous globally. Then your next question, how are we full of it? On the problem, I haven't had pushback. And I come from traditional banking. I speak to economists. I haven't had pushback.
And I mean, also just tangible examples. Like, let's look at what happened, during COVID to asset owners, which I own multiple businesses. I own real estate. I own digital assets. I was sitting home, waiting it out, getting richer. And I'm sorry to say that that's the case. Asset owners, wage earners, were having a harder time finding jobs. We're staying at home, waiting for subsidies, having a hard time. So that's during COVID. It was an extreme, magnascope on the problem, but that's happening even now post-COVID, or even before. We were seeing it over and over again. I mean, my house should not be worth what it's worth. Let's put it that way. Did you have a different opinion or comment, or sorry, go ahead. And our goal here is always to have that open debate with anyone who wants to come to the table with an open mind, and let's have a debate and let's get educated. That's all we're asking for. We're not trying to create polarization at all. It's about educating and bringing to the table people who want to learn and pick. Yeah, thank you.
First one's easier because that goes to custody and trust. That was on a panel earlier today on retail, I believe. I mean, we also have the ETF, so the registered wrapper makes it easier. I know we got some Bitcoin maxis in, it's like, regulatory wrappers. But anyway, it is a gateway drug, and we invite people to then go on to self-custody. Trust is a big deal, getting that thing. On the EM side, we've seen it. I think one of the biggest orange pillars, who's the gentleman from Argentina, Wences, I believe. He basically went out to the Allen and Company conference in 2012-13, orange pilled a bunch of people. And he said, you guys don't get it. My family's in one generation has lost their money 3 times. So I think that they are the greater adoption through stable coins or other.
And to add a bit more to the question, when you look at historical adoption of different types of monetary units, we know that it starts with proof is in the pudding that the technology is resilient, or that the foundation of whatever is created is resilient, whether it's seashells or digital assets back in the day. Then there's the accumulation phase, right? Or using it as an asset, which what we're in right now. And we're starting to see the next phase. Like once we all accumulate, at that point, then it becomes a medium of exchange. So again, we're trying to extend the lifeline. I mean, I remember as an early engineer thinking, well, in 3 years, all of this is going to be digital, and this, I'm talking my 20s, and it took 20 years, not 3, right? So what we're saying is follow the trend, follow history, you'll see where it's going to end up. But let's not come back here in a year from now saying we're still not all, using Bitcoin to buy stuff, right? It's going to take time, but we're in the accumulation, which is the asset accumulation phase. Oh, yeah, we got fun microphones here.
Yeah, it's just fun to catch.
Does this work? Oh, hey, how are you doing? If you're going to have bifurcated systems, like 2 types of systems, say there's a custodial system that you guys are looking at and there's a non-custodial, how do you guys propose to fight not letting those systems drift and both of them continue to interact over time?
My quick answer is I don't know. Everything we presented has been a living document. I update it all the time. My opinion changes based on the data. I don't know how to answer that.
Guys build education points. That would be a great research area, because that's something some of us on the deep end for decades have looked at, and more we see a very concerning trend that could happen, and it'll take people like you to actively fight that trend. We should never have a 2-type system. There should always be fluidity between the 2, and it is a death sentence if we go down that other road. So that's something you should think about then.
I think that's a great question. That's why, hopefully organizations like in conferences like we have today to openly debate. And I'm a fan of debate, not polarization like we're seeing in politics today. So how do we come to the table and say, what do we create? Like Mark was saying, we don't know what 3IQ will look like in 10 years. We're going to be, what does a digital asset manager mean in 10 years? But right now our goal is to play along with everyone else in the space to bring as many people as possible into the space, and then to be an active player to do what's right for society moving forward. And that question needs to be answered.
And are you talking about more self-custody, self-sovereign versus the registered wrapper?
Right, because there's a lot of people that have created things are in different systems, and as you have blacklists, as you have chain analysis, as you have all these other things coming on, you see a attack opportunity between the system that you guys will be creating, making, maintaining, and the system that has existed before. And they can definitely start to put on, through controls of wallets, software systems, you can't interact with these people, you can't interact like this. Like we all know the best way to ever wash Bitcoin is to sell it through the US Marshals. That's
why you come to conferences for lines like that. I'm going to use that forever.
It is. It's the best washing of Bitcoin that ever happened. The Silk Road Bitcoin, when they auctioned it, they legitimized every wallet address and every interaction that ever happened with those 25,000 coins. So yeah, but those are things that it's more like just work on. Like, maybe that's a good thinking point, because I'm seeing this and I'm like, yeah, and I see another war going on. I'm like, well, maybe you guys need to, make sure that doesn't happen with what you guys do. So
absolutely, I think, yeah.
Thank you.
Thank you. I'm seeing the Oscar sort of crowd. I think, no, we're good. We got more? Okay. Sounds good. Okay. Okay. I thought it was the hook coming. Who's got another question? Yeah.
Be careful. We got Aaron Cubes coming around.
Back left, and we'll go right here.
Okay.
Back left first.
All right. So to bring back a little bit like the conversation with regards to the younger generation and like what we've seen and what we should expect. So like I'm one of the people that raised their hands earlier when you asked who is under 30. And, for the last 10 years, I've been told by my parents and, like their friends and family, like buy a home, invest. And you spoke about the issue of like right now, nobody wants to buy a home. And with that environment, with the interest rates, we've been incentive, people were like, buy, you absolutely have to buy. And we've, a lot of young folks I've heard have a very like dark outlook on the future for that, especially with like interest rates and a lot of us having like variable mortgage rates. But at first I felt like pretty much only people who had variable rates would be affected that much. But like the whole economy is gonna, from my understanding, this might like trigger a domino effect that will bankrupt like millions of families in Canada. And while the rhetoric about increasing interest rates keeps going, I feel like it's getting worse and worse. And I'm just wondering at what point will the Fed pivot or not? And if Canada, like our debt ratio income, especially for younger folks, is horrible, and even the government might go insolvent. So I'm like, to what point will McLean, will the BOC go and bankrupt millions of Canadians and ruin people's lives for that imaginary like inflation number that they want to get to? So I don't know if my question is clear, but like, what do you think?
Totally clear. And I feel you. We all feel you. And I think really the question is when is the pivot? When is the pivot forced by the government?
Sure. I'm going to talk about your question on ownership and all that. First of all, we all, if you're born in 1900, the thing is, you woke up and you're drafted into the war with a tin hat, and then you went World War II. And I mean, everyone has it tough. You guys, and I have 4 boys, 21 through 28, so I kind of understand a little bit what's going on. You also have to take ownership of this, of wherever you are. Stand up and get loud, ask questions. And if someone bought a variable rate, they did it because it was cheaper, and now it was a bad choice. So they have to own that. So there's, that's just a reality. And then maybe as far as housing, I'm not going to give advice, but that's a totally different dynamic. Housing prices in 08, I don't know what you guys are, but I'm not going to touch that now because it depends on the market. What we're saying is that we think that there's an opportunity, that window opening is in digital assets, either working with the companies as they do it, owning the asset during the adoption period, and then once it stabilizes and reach maturation, it is that sound layer that will stabilize economies that we haven't had in forever. So let's talk offline. You had a big question. I do want to talk about it. I feel your pain. Get out of the FUD, exercise, have fun, get a girlfriend or boyfriend, whatever's your game, and just live life.
That's it. Well, great question. But to give it a little bit of perspective, that's a good one.
All right.
To add a little bit more in terms of when to predict, because we don't know what the future is going to hold exactly, but we look at key indicators of when pivots happen in the past, right? 3 things tend to happen. Number 1, and Mark, please add me if there's another one, but usually you see trouble in the banking system. We're seeing Credit Suisse, we're seeing Deutsche Bank, we're seeing others in Europe particularly. So that's starting to happen. Number 2, you start seeing issues of the repo market. We saw it in 2018, and you see it, you're starting to see it now. And then the third one, which is usually the last one, is usually basically capitulation in markets where they're halting trading days. I was talking with someone, I was in Vegas last week for another conference, and one guy was saying, we haven't even seen a trading halting day. The pain isn't maxed yet, but once those 3 things happen together and the system gets on the verge, the government steps back in, and then you get a pivot, just like in 2018, just like in other years. Feds, rates go up, they pivot back when the system's on the verge. So we got 2 of the 3 happening right now.
Yep.
Thank you very much, gentlemen.
Great.
Blockchain conference.
Thanks,
We'll sell you
everybody.
the whole seat, but you only need the edge. That was fantastic. Thank you, gentlemen. Huge round of applause. That was fantastic.
Thank you, everybody.